Hello everyone, my name is Jack Evans and I'm a financial advisor at Pegasus Capital Management. And recently you've probably heard some news about the potential for falling rates. There have been a number of interest rate cuts in 2025, and currently the market is predicting another cut in December and 2 to 3 cuts in 2026. And so what does falling rates mean for your portfolio? And I think the best place to start is how falling interest rates affect bond prices. And so the chart that's in front of you today shows various declining interest rate environments going back to 2000. It looks like there's about 11 of them. And what you can see is the cumulative return 1 year after, 3 years after, and 5 years after this falling interest rate environment. So if you zoom out, you can very much see that fixed income is an asset class that very much likes falling rates. That's generally a tailwind for bond allocations to return well in the intermediate term. You'll see the one exception is the falling interest rate period starting in 2018 and ending in 2020. You see negative returns actually for the following 3 and 5 year period. And that's largely because of actually increasing interest rates in 2022. During that year, inflation ran rampant, and the main way that the Federal Reserve will combat an increase in prices is to increase interest rates to quell economic activity. And fixed income portfolios do not like a rising rate environment. That was one of the few years where the equity markets and bond markets fell in tandem, and well-balanced investors definitely experienced some drawdowns in their account balances in 2022. But to see where we've been in 2025, and if the market is correct in additional cuts in 2026, it's realistic to assume that bonds might be able to provide some positive return for you over the next 3 to 5 years. If you have any questions on this chart or what we think about current asset classes, please feel free to give us a call at 913-327-1627. Thanks so much.